Hello traders, and thank you for joining us for today's webinar, which is a continuation of last week, and we're starting now Beginner's Technical Analysis Part 5, where we're going to be combining the MACD indicator, which we've discussed, with a new indicator called the ADX. So before we get into the new material, backed by popular demand, we're going to start with a review. Since I have an inbox full of requests to go back over the material, that's exactly what we're going to do. So when we first started from part 1, we began by describing technical analysis as a trading tool used to evaluate assets and attempt to forecast their future movement by analyzing statistics gathered from trading activity, such as price movement and volume. We mentioned that unlike fundamental analysts who attempt to evaluate an asset's true intrinsic value, technical analysts focus on charts of price movement and various analytical tools to evaluate an asset's strength or weakness and forecast future price changes. We discussed how technical analysts believe past trading activity and price changes of an asset are better indicators of the asset's likely future price movements than the true intrinsic value of an asset. So now that we know a little more about what technical analysis is, where will we conduct our technical analysis? Well, the answer to that question is netdanya.com. It's free to sign up for an account, and I recommend that you all do so you can save your workstations. This is called the chart station. And what we have here is a bunch of Japanese candlestick charts. Japanese candlestick chart is a combination of a bar chart and a line chart, and it shows price movement over time. So along the x-axis, the horizontal axis, we have time. And across the y-axis, the vertical axis, we have price, which is separated by pips. Like we said, a pip is actually the 4th digit from the decimal place. All right, and we see that we have 2 different types of candles. We have our blues and our reds. And each candle has 2 parts. Fuller part, a colored in part, and a spike above and below. Let me see if I can go right now just to a simpler chart, just to alleviate some confusion. Let's see. Okay, and here we have our Japanese candlestick chart. So let's talk about the blue candles first, which show a price increase for a specified time period. So what specified time period am I talking about? Well, if you go up to time scale here, you see that I have D selected. It means that each of these candles equals 1 day in time. If I want, I can make them 1 minute in time, 15 minutes, 2 hours, day, week, or month. And we'll talk about when to use each time scale a little later. So back to this blue candle here. So this part here that is shaded blue is called the body. Okay, so the bottom of the body shows the first or starting price for that specified time period. And the top of the body would be the last or closing price for that time period, showing a price increase for that hour. So above and below we see these spikes, which are sometimes called wicks or shadows, and what they show is the price range for each specified time period. So within this hour, the price went as low as here and as high as here, but it started here and ended here. So on to the red candles, which may appear on your screen to be orange. Maybe they are orange. And so the body, this time, the top of the body is now the starting or opening price for the time period. And the bottom of the body would be the closing or last price for that time period, showing a price decrease for the specified time period. And we see price going up, down, all day long, like a roller coaster. But when, you zoom out, you do see a general direction, which we call a trend and the ability for us to spot these trends give us great opportunity in trading. And in our first lesson, after we talked about Japanese candlesticks, we went on to discuss support and resistance, which refer to price levels on a chart that tend to act as barriers from preventing the price of an asset from getting pushed in a certain direction. We practiced drawing a few support and resistance lines that we use to signal possible points of reversal, which would also be good entry points for our trades. So let's see what we looked at last time. For instance, the AUD CAD. Let's talk first about support, which we would consider a price floor. So we could see after this long, strong downtrend that the price comes to a brief halt and then reverses upwards. And this has become a point of interest to me, so that's where I drew my support. And how would you draw a support line? You would come up here to lines, click Add Lines, and horizontal freehand changes your mouse into a drawing tool, and you can place lines wherever you want. And I'll delete these. So I've placed a line at the bottom of this downtrend, calling it a support level, and just out of curiosity, I decided to go a little farther back in time. And I could see that the price did end at a similar point, signifying to me that there is some strength behind this support. So now, basically, just to go off on a tangent here, technical analysis is the study of past movements of an asset. So the only way to teach it is to go back in time and figure out what we would have done in certain situations. So now we're pretending we're back in December. We just drew this support line on a D chart. So we're playing a long game here. And what we're doing is we go now and we wait for that price to reapproach that line where it's going to do one of two things. It can either bounce and reverse direction or break right through. So what will we do in each situation? Let's find out. So now we have the price coming close to the support level, but we want to see it actually touch that support level. So let's continue to wait. This one does not exactly touch. And here we have a touch. So this has touched our support level, and we see that it is bouncing back up. So what we would do in this situation is place a call position. Now, according to our time scale, we have the day chart. So what do you guys think? Are we going to place a 10-minute trade, a 1-hour trade, a 3-hour trade? No. The problem is, if we're on a day chart, we can't see what's going on within any particular day. All we can see is the day as a full. So we like to use the rule of Quattro, meaning that whatever your time scale is, multiply it by 4. So we would be taking a 4-day call here. So for us on this chart, it would be 4 bars. So from this bar, if we take a 4-hour call, you do see 1, 2, 3, 4 that the price did go up. So that would have been a winner for us. Let's see if we get any other opportunities. Okay, and here we have another bounce. Another great opportunity to place a 4-hour call, and the price does increase thereafter. Let's continue. We have another bounce, another 4-hour call, 4-day call, excuse me. 1, 2, 3, 4. That would have been a very, very close call, and depending on your entry, it most likely, if you got the timing right, it would have been a winner. But for those who were a little too late to place that trade, it would have been very, very close. But either way, I would want you all to know out there that none of these indicators or methods or strategies that I will teach you have a 100% success ratio, because 100% success ratio does not exist. Me, myself, I aim for 80%. Okay, so let's see here if we have any other opportunities. Okay, and here we see a breakthrough. So for you beginners out there using this strategy, we're not going to trade the breakthrough because it's indicating to us more power, a strength behind this trend, that it may continue. Now we can see if we go forward, that's not in fact the case, but you know what they say, better safe than sorry. Let's see if we see any other opportunities here. Okay, continuing to wait. We want to see the price touch that line. Now, at the time of the trade, this might have looked like a breakthrough to me. It would have been a full body because it only becomes the wick after the period ends. So this would have appeared to be a breakthrough to me. I'm not sure that I don't think I would have traded that. And you can see that the price decreased. So good, that would have been a good move to not trade. So here we actually do have a big breakthrough. So let's see, why are we staying away from the breakthroughs? And you can see that the price continues to fall. It breaks right through that support line, and that's exactly why we want to stay away from the breakthroughs. So that is what we showed for support last time. Now, let's see if we can do a resistance example. Okay, we see that at the end of this uptrend, I have drawn a line, and we can see the 2 periods afterwards also end in a similar point. This definitely indicates to me much strength behind this support line, and I actually have broadened it down a little, and I'll tell you why. Because when I look back in time, you can see the price of the Euro AUD never came close, not for years, hasn't come close to this value. So if I were to keep it all the way up top, I could be waiting around for a very long time. So we're doing a similar strategy with what we were just doing with our last asset, the AUD CAD. So now we're waiting for the price to approach the line. Okay, and here we have it. It touches the line. And so in this situation, we are taking a put, and we're again on a day chart, so it would be a 4-day put. Let's see what happens thereafter. The price does decrease. Would have ended down there, deeply in the money. Let's see if we have any other examples here. We might not, but let's. All right, the price comes close. Okay, here we have it. Right here, the price hits the line, and it's a bounce. So we were going to take another 4-day put. Not live, of course. And you do see 4 bars later, the price is much lower, deeply in the money. And that might be our last opportunity, but let's just make sure. Okay, so that is it for support and resistance. So after support and resistance, we went on to discuss RSI, which is the Relative Strength Index. The RSI, once again, is a technical momentum indicator that compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an asset. Last week, we compared the words overbought and oversold to overpriced and underpriced. And here's a little review of how to apply the RSI. So if we came over here to our USDCH, I already have the RSI here. If you want to add an RSI, you come over here to Studies, find RSI, click Add, cannot add the same study twice, and click OK. All right, so now we have our RSI. We can see that it's on a scale from 0 to 100, with 50 is what we would call fairly priced. And we have 2 main levels in mind that we're watching out for, is 30 and 70. So 30 we would call oversold, and 70 we would call overbought. So let's start with an oversold example. And you'll see I've drawn a line here right on the 30, just as a visual aid, just the same way as we would draw the line on the chart. Okay, so let's go back now and see if we can find some opportunities. So now, just give me a moment. Okay, so now we're watching this chart, but also we're watching the RSI down here, and we want to see the green line dip below 30. And let's see if we can find that. Okay. And once it dips below 30, we don't act immediately. we have to wait for it to cross back above 30. Okay, so now we're about to see it dip below 30 right here. Well, actually it hits 30, and that actually no, it doesn't even touch 30. Okay, so you want it to see it cross below 30, and here we go. We see it cross below 30. Now what we do is wait for the RSI to cross back above 30. The RSI always wants to be at 50. So let's see when it's going to start to go back. Okay, here in this between these two candles in this region is where we have our cross, and that's where we would place our trade. Once again, we're using the rule of Quattro. So this time we're on a 30-minute chart, and we would place, in this case, a 2-hour trade. But for us looking at the chart here, it's still just 4 candles. So let's see from this candle what happens 4 candles later. You'll see the price is all the way up here. So yes, our call position worked in this case. Let's see if we have another example. And once again, we're watching down here on the RSI. We're waiting for that RSI to drop below 30, indicating us that the price or the asset is oversold. And now we see it cross below 30. And right here, between these two candles, is where it crosses above 30. So here is where we would place another 2-hour call. And if we place the trade right here, 1, 2, 3, 4 candles later, it was a close call until the very end where it shot up, and that would have been an in-the-money trade for us. Let's see if we can find another example. And we're waiting for that RSI to go below 30 again. We continue to wait. Okay, so we're getting close to the 30, but if it doesn't hit that 30, I don't recommend acting. I'd like to see you guys wait until the 30 is hit. Okay, so where is our chart? So right now we have this downtrend, and we see the price went below 30. Let's see where it crosses back up. And here is where it crosses back up between these two. Well, it's in the beginning of this candle. So here is where we could take a 2-hour call. So 1, 2, 3, 4 candles later, and the price is well in the money. And let's see if we have another example with this asset. Remember, we're watching the RSI down here. We want to see it cross below my 30 line that I've drawn. And that might be it. Maybe we'll have one more example. Okay. So here we have it cross below 30, and here between these, actually it's in this candle near the bottom here, is where it crosses back above the 30, and that's where we would place our 2-hour call. And this one actually would not have worked out for us. So I go back to what I said earlier, that none of these indicators will work 100% of the time. So we do have the price drop below 30 one more time, but I have a feeling that this one might not work as well. But either way, the trade would have been around here to take another 2-hour call. And the price, we just have way too much downward momentum right now that possibly from some fundamental news that is hindering our RSI. And I want to show you just one more example with the RSI because we can also use it in the other direction. So this time I've drawn a line on 70. And now we're going to use the RSI to spot overbought conditions. So just give me a second while I get set up with this asset. And I guess, well, just 1 second. Okay, so let's just start here. All right, so we're watching. And we see that our RSI crosses above 70. So, and immediately after that, it crosses back below between these two candles in this region here. So this is telling us to take a put position now. And you can see we're on a 2-hour chart. So this would be an 8-hour trade, or if you're looking at the chart, 4 candles. So if we go into the future, we do see the price drop 4 candles later. And that would have been an in the money trade for us. Let's continue. And we're looking down here to see the RSI come above 70. And we're still waiting. We don't care if the price comes near 70. We need to see it cross over the 70. And we might be about to see that. It's kind of shocking to me that this candle here didn't do it, but it's probably because it came right after this strong downward momentum here. So let's see if we can find another example, and then we'll move on to our next indicator. All right, and that might be it for today, but I just want to see because, all right, we have one more. We see the price cross above 70 here. Let's see when it crosses below 70 here. The beginning of this candle is where we would take another 8-hour put. And let's see what happens. The price drops tremendously. It's amazing. Perfect indication from the RSI. Okay, so maybe we have another example. Here we have a cross above 70. Now we wait for the cross below 70. And it happens in the end of this candle, right around this area. And that's where we take another 8-hour put. And from this level, we could see that this level here where it would have expired is lower. So that would have been in the money. All right, let's continue. Not a crossover here, false alarm. And that's not a crossover as well. Okay, so here we have a cross. You can just barely see it. And then it immediately shoots out. So somewhere in this area is where we would, well, actually, no, it would have been before this candle. You can see that it's right around here, right around the end of this candle. Probably around the time where the spike was peaking up a little bit and then came right down to end that period right here is where it would have dropped below 70. So here is where we could place an 8-hour put. And let's see what happens. And you see the price fall thereafter. Beautiful. Okay, so I just want to go until we are live because I think I saw the GBP USD close to the RSI at this point, to the 70. So there's one more example there. Okay. And I'm going to do my best that if I spot any worthy signals for you guys out there today, I'm certainly going to give them out. And we have not even looked at a live chart yet, so we're going to get there. All right, so right now, the GBP USD is approaching 70, so those of you out there, maybe if we switch to a different chart, we could see something different. 70 is what we're looking for again. So when you're on a 30-minute chart, you can see that it got much closer to 70. Each chart is going to tell you a different story, and you're going to trade a different time horizon for each scenario. So here we have it. Okay, right now we're on a 15-minute chart. It's telling us it just crossed below the 70. So right now we can take a 1-hour put on the GBP USD. So I'm actually going to take this trade. GBP USD put for about 1 hour from now would be, well, that's the closest I'm going to get. So, yep, that's a pretty strong signal. So I'm going to take that put for the GBP USD, expiry 16/15. All right, let's continue. That's exactly what I thought I saw. I'm glad I spotted that before we began, so we were able to do something with it. So after we discussed RSI, we wrapped up there, and the next session, the next webinar, we went on to discuss, first of all, moving averages. Moving average is simply a way to smooth out price action over time. Moving averages mean that you are taking the average closing price of an asset for X number of periods, just like any other indicator. Moving average indicator is used to help forecast future prices. By looking at the slope of the moving average, you can better determine the potential direction of market prices. So more on that later. We touched upon MACD, and we're going to build off the MACD today. But so MACD, it stands for Moving Average Convergence Divergence, and it's usually one of the first indicators learned by traders, new traders, and in many cases one of the first oscillators that traders will apply to their charts. It is also very common for those same traders to give up on MACD and stop using it, claiming that it doesn't work. It's definitely true that MACD doesn't work 100% of the time, but this is partially due to improper usage. The MACD is a very logical indicator. It does just what the name says. It measures the spatial relationship of two exponential moving averages. And what is an exponential moving average? Well, a simple